You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you're doing well on this Tuesday. Last week, it was a very interesting week in terms of companies' results, where TFI International and Canadian National Railway reported their latest earnings for Q3. I said interesting because if you want to know where the Canadian economy is going, well, there are like a few major retailers that you can look at, such as Canadian Tire, but my favorite place to look is transportation, because if the economy is slowing down, well, the first thing you're going to see is the transportation companies are going to follow. So let's take a look at those two companies, see what they have to say about their quarter and what it tells us about the last quarter of the year, what's going to happen in Canada. So let's start with the good news. TFI International reported some kind of like a good quarter, I would say. So earnings per share were up 2%, which is like not incredible, but it was okay. Revenue was up 14%, mostly fueled by the acquisition of Daiseki, I'm sorry if I don't pronounce it correctly, but yeah, so that was like fueled by acquisition. And the most interesting news here is the generous dividend increase of 12.5% or 13% if you want to run it up of their dividend. So dividend increase of 13%. Last year it was 14%. The company shows a 5 years dividend growth rate at double digit and still shows low payout ratio, which is clearly amazing. I mean, just for this quarter, imagine that it declares a earnings per share of $1.60. It will pay moving forward 45 cents per share. So that counts for a payout ratio of 28%. So when you find a company offering you double-digit dividend growth rate with such a low payout ratio, you can expect that this business will be able to continue growing its dividend, and even better than that, it grows through acquisition, so they have plenty of capital right now to do both. So reward shareholders short term with the dividend increase and reward them for the long term by acquiring companies and growing. However, that's pretty much it for the good news. TFI International still mentioned that the overall business was facing challenges. There is a reduction in volume due to continued weaker transportation environment. There is also a reduction in the fuel surcharge revenue. So the company is, yes, growing by acquisition. It's usually like their playbook, where when the economy slows down a little bit, they are the first one to be able to acquire struggling competitors, benefiting from their economies of scale and wide network. But in the meantime, it will likely not be a great end of the year for TFI International, just because they are a victim of the market. Whenever the economy is slowing down, well, transportation businesses are not at their best. But it could be an interesting entry point, as the stock price is not moving too high these days. Moving on to Canadian National Railway. That was a lot more modest, but of course, like one of the biggest downside of investing in CNR is probably the fact that there is a lack of growth. I mean, if the economy is growing, they're going to grow. But besides that, since they failed the acquisition of Kansas City Southern, that bid was won by Canadian Pacific, CP. Since then, there is not much growth expectation here. So revenue grew by 3%. Earnings per share was up by 2%, which in perspective is kind of like a good news. Thinking that I was expecting actually a slowdown in the revenue, to be honest, and probably a slowdown in the earnings per share. So now if we see small increase, it's better than nothing, I would say. What happened is revenue in grain and fertilizer segment was up 8%, which was pretty solid. And then there was intermodal that was up 7% for revenue ton per miles, but unfortunately, overall revenue for intermodal were flat. There was a decrease of 10% in the automotive segment. That definitely not help. Another sign that the economy is slowing down if people are not buying any more new cars. So overall, not a great quarter for National Railway. One thing that caught my attention was the operating ratio. That went up by 110 basis points. So the operating ratio for the quarter was at 63.1%, which is a lot higher than usual. You want to have the operation ratio under 60% most of the time. That will show you that the company is like highly profitable, and at the same time they are investing enough to maintain the railroads. One of the reasons why the operating ratio was so high this quarter was due to an increase of fuel and also labor costs. They got into some heavy negotiation, some strike as well. So, of course, when there's a strike, there's eventually going to be a deal, and then there's going to be more labor cost included in the deal that they signed with the union. So overall, the tone was pretty much the same from both CEOs, saying that they are facing challenges. They see that the volumes are slowing down. And I mean, on one side, TFI is still looking to tap into new acquisitions. That is their playbook. For CNR, they will focus on optimizing their margins, so lowering their operating ratio to become more profitable. So during like slowdown, it's usually the best course of action is, well, you know that people will call you when they need to transport goods because you have the railroads on your side and nobody can mimic that business model. In the meantime, you just have to focus on operation costs and become leaner, more effective. And then when the economy goes back up, well, your income, your earnings per share will grow faster. So I expected actually a worse quarter in a sense where I thought the economy was maybe in a worse shape than I expected. I expected the economy to be in a worse shape, so that's relatively good news, I would say. So I'm not like super enthusiastic over those results, but it's actually good. Maybe it tells me also that maybe we will achieve that unicorn like event of a soft landing, maybe on both sides of the border. The Fed and the Bank of Canada will be able to reduce the interest rate right before we hit a recession. That would be a first, and that would be quite impressive. But certainly a good thing for the overall stock market, because if consumers can breathe a little bit more and not suffer too much, and then we can see companies making more money down the road in 25 and 26, that's just going to be like the perfect scenario for everyone. In the meantime, as you know, I'm always invested, so I don't mind too much. I don't have TFI International in my portfolio, but I do have Canadian National Railway. This is the type of business that I just like to have in my portfolio because it's there. I can forget about it. And from time to time, I look at the results and I'm just like, hey, I'm up like more than 100% on this one because I've holding it for a long time. So the message I got from those two companies is, yes, they face challenges, but it's not that bad, and they are confident to go through this maybe like slower period, but definitely not something close to a recession, which is definitely good news. All right, Moose, that's enough for today. I hope that you have enjoyed the show. If you have not done it yet, please take 2 seconds to give me a 5-star rating on Spotify or Apple Podcasts. This is pretty much the only way I can grow the podcast and reach out more people. So, all right, I appreciate your love, and we're going to talk again tomorrow. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.